Today, I want to talk to you about costs and fees. I got an email recently from someone, and they're like, Kit, I'm really concerned about investment fees. And I was recently given a proposal by a professional investment advisor, and it looks like some of the funds they chose are a little bit more expensive than my current experience. And I'm wondering, why would anyone ever do that? Why would I choose to invest or build a portfolio that's more expensive when there's cheaper options out there? So I want you to walk outside or look around the next time you're in your car to all the different vehicles that are out there. There's cars, there's trucks, there's bicycles. You may even have people on scooters. Why are they choosing that particular vehicle to get to where they're going? Are you getting in a pickup truck? How about a Toyota Prius or an electric vehicle? Riding the bus or a train? Maybe you're just walking to your office in your house. You don't even have a daily commute. We all have different choices we make in how we get from point A to point B. And we need to humble and be human to the fact that everyone's needs are different. Now, online, there's a growing chorus, especially if you're a new investor, that whatever you're doing, the number one way to save money is to cut costs and just find cheap everything. And what's great is that the market has responded in the last 20 years, and the average cost of an ETF and mutual fund has come down by over 70%. So the idea that you can just continually shave costs out by finding a more efficient vehicle, the market's already priced that in for you, and the average consumer already has access to that. So the next thing you need to look at is what process do these underlying mutual funds use to serve the allocation that they're going to provide you? Great example. Vanguard's value fund is going to look different than iShares value fund. It's going to look different than Dimensional Fund's value fund. They might even have 6 different value funds from you to choose from. They might have different costs between them. And if you plot them on a chart and look at how they did the last 3 years, 5 years, and 10 years, you might be shocked at which ones did better than the other and by what degree they did it. In this example, there's a client of ours, we were just comparing the Vanguard value fund to a Dimensional Fund's value fund. The Dimensional Fund's value fund did very well. Does that mean that that value fund is entitled to repeat that premium again in the future? Absolutely not. But it informs us of how those Fund A, in this case Vanguard, compared to Fund B, Dimensional Funds, experienced and generated returns in the near term, and how we may see similar discrepancies in the future. It could be reversed next time. Now, Vanguard has a specific way they built their fund. You can read it in the prospectus. Dimensional Funds has a different way of doing it. And I bring this up not to tell you that one is right, but that you need to find the one that's right for you and you need to understand it. And then second, if you are working with an investment professional, they're going to usually tilt you into a globally diversified portfolio. And globally diversified portfolios are going to have assets and investments that exist outside of the United States. Western Europe, Japan, India, emerging markets like Vietnam. There's all these little sub-markets and places they may be buying bonds or actual equity in companies. And those markets are just not as efficient as the United States. It's more difficult to go out and build even an index fund in those particular markets. So the cost of them might be 50 or 60 basis points as opposed to the 12 you're used to paying in the United States. And that higher fee isn't gouging you. It's not necessarily mispriced. It's just that's the best they can do in a smaller market. There's just less liquidity there. There's less people to make the market. So the discrepancy in bid-ask prices as well as ongoing ability to access that market is going to be different than the US market, which is currently the largest in the world, has ample liquidity and a major of regulations and case law to support the fluidity and operation of it on a level that has global trust that is rivaled by nobody. And there's some great markets out there with a lot of trust. So when you look at costs, don't ask yourself, don't be burdened by the fee. Ask yourself, what value is it creating? Is it creating enough value to justify that fee? And more times than not, you're gonna get a lot of value for it. And I bring that up not to say you should just pay more for everything so much as don't be afraid to pay a little bit more, whether for a professional advisor or for different types of funds and different asset classes that are designed and built to serve your financial plan. Now that leads me to my last point. What is your financial plan? What rate of return do you need? I have no idea. If you're working with a financial planner, they're going to be able to tell you, hey, look, you only need to make 7% a year, 5% a year at your current savings rate to hit your investment goal for retirement or a major purchase or whatever that may be. And most financial planners, myself included, are going to figure out like what's the least amount of risk we can provide a client to get you to your goal based on your current amount of investable assets and your savings rate. Most financial planners are not interested in just getting optimized return, the highest return possible. And if we take on a bunch of risk and delay your goal, it's so what? That's usually not how financial planners work. Financial planners are solving for you and your goal. So they may even throw in socially or environmentally aware funds that you've never heard of, but they know that being socially or environmentally aware is important to you. Might cost a little bit more, but at the end of the day, if that drives value for your peace of mind, that less or none of your money is going into companies with values that are inconsistent with yours, that creates value. There may be asset classes in there that are expensive, commodities, high yield bonds, small cap stocks, emerging market stocks. These are expensive, but they may be providing some great diversification for you that it's just difficult or you wouldn't have found on your own. So don't ask yourself, oh, what does it cost? Ask yourself, what does this do for me? How is it creating value? Until next time, my name is Kit Lancaster. I'm a certified financial planner, and my job is to help you make more informed decisions about your finances, your life, and to challenge you to build a plan professionally or on your own that's hyper specific to you, being mindful of, in this case, over 15,000 options just in index funds and mutual funds to consider. Until next time, we hope you found this helpful and have a great week.